Okay, let's unpack this. Welcome back to the deep dive. Today, we're giving you, well, sort of financial x-ray vision. I mean, many of you listening probably have a sense of what liabilities are debts, basically, and shareholders' funds, what the owners own. But today, we're really pushing past those simple definitions. Our mission, really, is to show you how digging into these specific numbers, these two categories, offers this almost forensic insight into a company's real financial agility, its resilience, and yeah, its potential to either innovate and really thrive or maybe struggle.
Yeah. What's really powerful here, I think, is that by understanding these specific parts of a company's balance sheet, you gain a really practical lens. It's like moving from just seeing a company's public face to understanding its insides, its
Yeah.
operations, its obligations, what it owes, and ultimately its actual value. We want to get you
Yep.
straight to the why it matters behind these numbers, not just the what they are.
Absolutely. Exactly. Because by the end of this deep dive, you won't just, know the terms. You'll have a much clearer picture of how companies actually manage their debt strategically and what genuinely belongs to their owners, and crucially, why that difference can signal, well, everything from maybe trouble ahead to really solid self-sustaining growth. We'll layer in some tangible examples to make it useful for you. So, okay, let's start our financial detective work. Let's talk liabilities. Most of us get debt intuitively, but in business, it's definitely more nuanced. Before we dive into the weeds, though, maybe for anyone who's a bit newer to looking at company financials, can you just quickly set the scene? Where do liabilities fit? We keep mentioning the balance sheet. What actually is that?
That's a great place to start. It gives context. So think of a balance sheet as a snapshot, a financial photograph of a company at one specific moment in time. It shows what the company owns, those are its assets, what it owes, those are the liabilities we're talking about, and then what's left over for the owners, that's the shareholders' funds. And, well, like the name says, it has to balance. Assets always equal liabilities plus shareholders' funds. So liabilities are that really crucial piece representing everything the company has promised to pay out to others, external parties.
Got it.
Right.
Okay. Like a snapshot, a status update. Makes sense. Now, moving to those promises, those commitments, liabilities aren't just vague ideas of owing money, are they? They're specific. And what's interesting is, like you said, not all debts have the same weight or urgency, especially in business. There's this fundamental split that completely changes how we should see a company's immediate pressure versus its long-term plan. Can you walk us through that, the difference between current and long-term liabilities?
Absolutely. And this distinction is, well, it's foundational. It speaks directly to a company's liquidity, its ability to pay bills now, and its solvency, its longer-term financial health. We basically split liabilities into two main buckets, current and long-term. Current liabilities are essentially those debts the company really has to pay within 1 year, soon. They represent the company's short-term financial commitments, the immediate bills, you could say. Let's maybe use an example. Imagine like a growing tech startup. Its creditors are a current liability. That's the money it owes its cloud provider, maybe its hardware suppliers, or that marketing agency it hired. Now, in American English, you'll often hear this called accounts payable or just payables.
Ah, right. The terminology thing.
Yeah, exactly. Same concept, different name. And if that startup has, say, a tight cash flow wink and spends a bit more than it has in the bank, that short-term borrowing is an overdraft, another current liability. Then you've got interest payments due soon on any short-term loans. And, of course, tax payable money owed to the government, usually within the year. These are all immediate obligations. They tell you a lot about the company's day-to-day cash management.
That makes perfect sense. It's like checking your own monthly bills, right? Your credit card, rent. But why is it so critical for us looking from the outside to know these are short-term pressures? What's the immediate flag?
Well, this raises an important point for you, the listener. Understanding this helps you gauge that immediate financial pressure versus the long-term stability. A company with, say, a really high chunk of current liabilities, especially compared to its current assets,
Yeah.
cash, money, customers owe it. It could be like someone with a huge credit card bill due next week, but only enough cash for groceries. Same.
Yeah. Okay. Tight spot.
Exactly. They might struggle to meet those immediate payments, even if the long-term picture looks okay. A quick thing listeners can look at is the current ratio. You just divide current assets by current liabilities. If that ratio is close to 1-to-1, meaning assets just barely cover those immediate debts, that's a bit of a warning sign for short-term health. If it's below 1, then you could be looking at potential liquidity problems, serious ones.
So it's not just what they owe, but when it's due. That paints the picture of immediate risk. Okay, so moving beyond that 1 year window, what about the longer commitments, the long-term liabilities?
Precisely. That's the other side. Long-term liabilities. These are the debts that stretch out further into the future, beyond that first 12 months. Think of these as more substantial. Strategic borrowing, often funding bigger projects or sustained growth. Common examples, long-term bank loans. Significant sums borrowed from banks, often repaid over several years, maybe 5, 10 years or more. And another key one is bonds. Think of bonds as the company borrowing money directly from lots of investors, not just one bank, often for really large amounts. And typically over longer periods too, maybe 10, 20, sometimes even 30 years.
Wow.
Yeah, it's a strategic choice for how they manage their long-term funding. It can offer maybe more flexibility or sometimes lower interest rates than a massive bank loan, especially for big established companies. So while these are still definitely debts, they tell a different story. It's about financing the long-term vision, not just keeping the lights on day to day.
That distinction really helps. Yeah, it's like you said, the difference between that looming credit card bill and maybe a well-planned 30-year mortgage. One signals immediate stress, the other potentially smart long-term planning for something big.
Okay, so we've got a handle now on what a company owes. Let's flip the coin. Let's look at what's considered the owner's share, that thing called shareholders' funds. This is where we see the wealth building, right?
Indeed. Moving from what a company owes to what effectively belongs to its owners. Yeah, that's a crucial shift in perspective. Shareholders' funds, fundamentally, are what's left over after you take everything a company owns, its total assets, and subtract everything it owes, its total liabilities. What's fascinating here is that this figure, it represents a theoretical residual value. It's basically the net worth of the company from the owner's point of view, and it's a really powerful indicator of how much wealth the company has actually built up for those owners. And just to really nail that down, let's use that classic kind of theoretical scenario. Sometimes stripping it down helps. Imagine a business just stops. Tomorrow. Done. It pays off all its debts, the short-term ones, the long-term ones, everything. It collects all the money owed to it, say, from its customers, and then it sells off everything it owns, buildings, machines, inventory at fair market value. In theory, what's left, that pool of cash remaining, that's exactly what would go to the shareholders. That's shareholders' funds.
Precisely. A perfect illustration. And shareholders' funds are typically made up of two main parts. First, there's the share capital. This is the initial money shareholders put directly into the company when they bought its shares, usually when the company first issued them.
Right, the seed money.
Kind of, yeah. The foundational equity investment. The second component, and this one is often really significant, is retained earnings. You sometimes hear these called reserves as well. These are basically the accumulated profits the company has made over the years from running its business. But crucially, profits it has chosen not to pay out as dividends to the shareholders. Instead, these profits are kept, they're retained by the company, and usually reinvested back into the business for growth, expansion, or just building a financial cushion.
Ah, okay. Another one of those terminology things then, like creditors versus accounts payable. There's a slight difference here, too. We've been saying shareholders' funds, which I gather is more British English. But if you're looking at, say, U.S. companies' reports.
Yeah, you'll often see it called shareholders' equity, or sometimes even owner's equity. It's pretty common in American English.
Okay.
But for our listeners, the key thing is it's the same fundamental concept you're looking at. What belongs to the owners after all debts are considered?
Got it. Shareholders' funds, shareholders' equity, same idea.
Exactly. And the crucial takeaway, I think, is that this figure gives you a direct, kind of unvarnished look at the company's financial strength from the owner's side. It shows not just their initial stake, the share capital, but critically, how much profit has been successfully kept and reinvested over time in those retained earnings. A company where retained earnings are steadily growing. That usually signals strong, self-funding growth. It's building its own wealth internally.
Right, using its own success to fuel more success.
Precisely. It shows it can fund future projects without always having to borrow more or ask shareholders for more money by issuing new shares. Conversely, if you see retained earnings declining, or even negative, that can be a serious warning sign. It might mean the company is consistently losing money, effectively eating away at its owner's capital.
That's a fantastic point. So it's not just about the initial buy-in, but how good the company is at reinvesting its own success. That retained earnings part seems key. But what if a company has high shareholder funds overall, but low retained earnings? What might that tell us?
That's a really sharp question. It gets into strategy and company life cycle. You could have substantial share capital, meaning a lot was invested initially, but relatively modest retained earnings. Why? Well, maybe it's a very young company. It just hasn't been profitable long enough to build up big reserves yet.
Okay, that makes sense.
Or it could be a very mature, stable company that has a policy of paying out most of its profits as dividends.
Ah, giving the profits back to shareholders instead of keeping them.
Exactly. So for an investor looking at that company, low retained earnings, especially if it's older, means one of two things. Generally, either it's not generating huge profits or it's choosing not to keep them for internal growth. Now, neither is automatically bad. A
Yeah.
high dividend payout might be exactly what certain investors are looking for.
Right, like income investors.
Precisely. But it does mean the company isn't building its own internal financial muscle as aggressively as one that's reinvesting heavily. It just points to a different strategy, maybe a different phase in its life.
That makes perfect sense.
Vector.
Yeah, it really is all about the context, isn't it? What story those numbers tell together. Okay, so wow, you've really unpacked two absolutely fundamental parts of any company's financial story here. Its liabilities, what it owes. Both the short-term stuff, like paying suppliers or covering an overdraft, and the longer-term, more strategic debts, like big bank loans and those corporate bonds. And then its shareholders funds what's truly left for the owners, made up of their initial investment, the share capital, and those really important accumulated reinvested profits, the retained earnings or reserves. Understanding these two concepts and the nuances like current versus long-term or share capital versus retained earnings, it gives you a massive advantage, doesn't it, in assessing the financial health and the strategy of pretty much any business you look at.
It really does. And this maybe raises an important question for you, our listener, to think about as you go about your day. Think about the companies around you. Could be your favorite coffee shop, a huge tech company, maybe where you work. How do you think they're balance that mix between liabilities and shareholders' funds? How does that affect their ability to do things like innovate new products, expand into new places? Or maybe most importantly, how does it affect their ability to ride out tough times, an economic downturn, some unexpected crisis? Just consider what those figures, liabilities, and shareholders' funds truly say about their resilience, their future potential. Is it set up to thrive and grow, or just survive?
Absolutely. It fundamentally changes how you see the business world, doesn't it, when you start looking through that lens? We really hope this deep dive has given you some powerful new tools for understanding the financial stories playing out all around you every single day. Keep being curious.